Welcome to the Thursday edition of the Not Your Average Investor Show, the JWB Rental Liquor Property of the Week. I'm your host, Pablo Gonzalez. With me, as always, the man that I affectionately like to call GC because of his genius concepts, because he generates cash flows, because he knows has a great co-host, because his parents called him Gregg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you.
And the real star of the show, we call her MTM because she brings the moments that matter. She is Madison the Magnificent. Say hello, Madison.
Hello, everybody.
And I just want to welcome our audience, welcome our community to the house. Everybody checking in the chat. I love it. If you are watching us on YouTube live right now, or you are listening on the podcast later in the future, or watching on YouTube later in the future, love having you here. Something about the show. It's community driven. So the right way to experience it is to go to nyais.com, sign up there, put in your address, your email address. It'll send you a calendar invite. Put it on your calendar. And one of these days when you're open on a Tuesday or Thursday and you want some company and you want to laugh, you want a little extra energy, you join us live and you get to be part of what, GC?
The roll call.
The roll call. That's where we check in with everybody in the community, just so you know. And right now we got Madison already leading us off. Welcome to the Not Your Average Investor Show. We got the ringmaster of the Not Your Average Investor Show community, Drew Barnhill, in the house saying good afternoon. We got Lee Bishop, the MVP of the Not Your Average Investor Show community, saying good afternoon, everybody. We got our usual leadoff hitter here, batting third, John Henning, saying good afternoon. We got the patriarch and matriarch of the first family of the Not Your Average Investor Show community, Ken and Carolyn Moline. We salute you. We got Stevie B in the house. Stevie B, welcome to the show, my friend. Good to have you here. We got Chris Gonzaga from the illustrious Hudson Valley of New York. We got Leo Faraganan. Faraganan. Say good morning from the Bay Area. Let's rock. Who else we got? We got the man that everybody knows from California, checking in with us, Noah Randari, saying hello, everyone. We got, all right, this is Donna Chica's back. Donna, welcome to the show. She says hello all. And we've got the fairy godmother in the house, Jen Filzen from the beautiful Monterey Peninsula, checking in with us. Let's kick this thing off with what I like to call my favorite segment.
Absolutely.
Which is Madison Shares Good News.
Hello, everybody. All right. So some good news I have today. I just wanted to congratulate some of our new and veteran community members for living out one of JWB's core values. You're either growing or you're dying. So by growing or dying, I mean they are continuing to grow their portfolio to reach their investment goals. Darlene and her husband, William, are newer members of the community. I think they just joined a few weeks ago. But they have been clients of JWB and they have already added a lot of value to the community, and they just put their 5th home under contract.
All right, 5th house. That's incredible.
Yes. Congratulations, guys. And Peter James from the esteemed Commonwealth of Virginia.
Tip of the hat. Tip of the hat.
Put his 2nd home under contract. And when he doesn't normally check in, but I see his name pop up, so I update his record a lot.
Mm-hmm.
He put his 3rd property under contract.
All right.
And a super special shout out to someone who brings such value, such energy to the community, our fairy godmother, for putting her 6th home under contract.
Woohoo!
Let's go. Jen Filzen. Congrats.
Congratulations, everybody.
Jen, Yen, Peter, and Darlene. That is incredible for all of you. So I'm just so thankful to have you here as a part of the community and growing your portfolio. And for Jen and Darlene, their past 5 properties. What does that mean, Madison?
It means their management fee goes down.
Mm-hmm. What does it go down to?
That's a good question. 9%.
9%. There you go. Just rapid fire
Boom.
firing squad here. Yeah. When you put your 5th home, when you own 5 JWB rental properties, your monthly management fee drops from 10% to 9%. And then when they get to 10 properties under management, it will drop again. It'll drop from 9% to 8%. This alone saves you thousands of dollars a year in expenses, which goes straight to your bottom line, additional cash flow. So congratulations to all of you. That's incredible.
You know what I call that?
What?
I call that good news.
There you go.
All right. So I want to shout out to a couple of new community members that shown up since the roll call. We got Nadeem Shah in the house from the West Coast, and we've got Aaron O'Neill into the night. Aaron is still asking for a new nickname. Aaron, I really
I think
enjoy.
we can give it up.
I can do it, Aaron. I just enjoy it so much. I also want to give a shout out to Michael Santorio. So we often will be wrapping up the show and someone comes in with a question. Oh, we got Greg Stone, Greg number 2 in the house.
My better version of
Checking
myself.
the better
Greg.
version, the better Greg. Checking in from New Jersey. I want to give a shout out to Michael Santorius, right? We're always like finishing the show and we say, man, we don't have enough time. Why don't you pop this question into the Facebook group?
Right.
And nobody ever does.
Very rare.
It rarely happens, but whenever it does, GC goes in there and answers it.
Yep.
So we just want to make a point of that, Michael, that you get the week's MVP of last week. And we're just going to bring up the question because we want to encourage this activity, the idea that we can all communicate in between shows. We are a community, get to know each other. So Michael Santoris had asked, hi, everyone. I'm new to the world of dealing with septic systems and know that they do require maintenance from time to time. Does JWB collect data so we know when maintenance and possible replacement is needed before the system fails? What do you think, GC?
Well, I went and I asked our team that exact question to try to get more information on how we prevent septic problems as best as we can. The data collection on it, that would be pretty difficult. So the data collection isn't something that we do. I don't even know how you kind of do it, but we do a lot of prevention when it comes to placing the right resident into the home with the right expectations. And so I just wanted to share some of the things that we do. We have set our expectation on max occupancy for a home for septic properties based on acceptable living standards, but also on maximum water usage. And so the actual maximum usage that we will allow is 100 gallons per bedroom per day. And so that would limit it to a 2-bedroom home having a 4-person max occupancy, a 3-bedroom home having a 6-person max occupancy, and a 4-bedroom home having 8-person max occupancy. So, we all know of situations where landlords, have a lot of people living in a small home. We don't do that, right? And we don't do that. It's not because it's just a standard practice within the city. It's also specifically to prevent septic issues on homes that are on septic. We do a lot of training and molding and guiding new residents what it means to take care of a septic system. We have a special septic addendum, and it's given to every resident when they move in. If there's a septic, if it's on septic. There's also an additional resource that we give out that was from our septic provider on how to prevent issues on the septic side. So there's a whole lot. And then, for those septic system, we talked about PBTS septic systems, which are basically septic systems on a smaller lot, which is really common for inventory here for new construction homes here in Jacksonville. As a part of the septic system that's on a smaller lot, that PBTS, it's a requirement to get an annual inspection. And so that would be an inspection that is done. And there's, of course, preventative maintenance that is checked on that. If you have a septic system that is not on a small lot, it's a regular septic system, there is no requirement for annual maintenance there. So you don't have that inspection every single year. But those are some of the things that we do to prevent septic issues, Michael. And thank you so much for your question.
There you go. So not a lot of data coming from that doo-doo, but you did do your due diligence in figuring out everything you need to know about septic real quick.
I was knee deep in septic here.
You're up to your elbows in it. Jeez. All right. So shout out to a couple of community members that checked in. We got Denny Davis checking in. Guten Tag, Denny coming in. And we got Marilyn Cotterman from Homosassa, Florida.
Home of the manatees.
Checking in. And we got Eves Richard. Where are you? Eves Richard Dole also checking in. Good to have you back, Eves. And Kelly Berenbaum is asking a question. That's a new name.
New name.
Kelly, or maybe the first time checking in. Kelly, love to have you here. She's asking, or he's asking, I think Kelly can be a guy's name or a girl's name, but I don't want to be insensitive. So asking, septic tanks seem to be in focus lately. Not a big thing where I live. Roughly what percentage of JWB properties have septic tanks versus city hookups?
Oh, goodness. 1 to 2%. All right. So Madison was saying that 1 to 2% of the inventory that we're selling right now has septic. And, I would think if I'm looking even beyond the inventory that we're selling right now, I would think it would be a higher percentage of that, but it's not a majority. So the one of the ways that we're able to provide inventory right now is because we stumbled onto a niche over a decade ago of being able to find infill lots and building new construction homes on infill lots. And in the neighborhoods where we are able to do this, a lot of these have small lots, and small lots for you as a turnkey rental property investor are a great thing because it allows you to keep your costs of purchase, like the build costs need to be lower for a smaller house. So your costs of purchase are lower, which gives you a better chance for you to hit your return requirements. You know, it's the way that that's the way that we provide returns at 11% or 12%, 13%. So small lots are a key to our strategy when it comes to new construction homes. Now, small lots, if they're on septic, a huge percentage of those are these performance-based septic systems. So we were able also to uncover the strategy of how to put a septic tank on a lot that is smaller. And in a lot of these neighborhoods, you don't have access to city water and sewer. So it's a whole lot of the JWB innovations department that has worked together to make this happen. So I would say it's larger than 1% to 2% if I go back in the history of all the properties that we have sold and that we manage, the $800 million of homes that we manage there. I would think it's higher than 1% to 2%. You know, if I had to guess, maybe 10, 20% overall would be my guess. So it's certainly not unique, but it is not a majority.
I love it. I was gonna bring it up. The JWB R&D department,
Yeah.
right? Like the R&D department that has brought you such things as build to rent and container apartments and new innovative ways to do a septic system. Pretty cool.
There you go.
I never get tired of the idea that like JWB operates like a, you know, Silicon Valley tech company, and you have like your like budget for R&D as well as the flywheel, like the data flywheel and all the things that you do to really just like run this thing like a well-oiled machine. And I never get over it. Love it.
Absolutely.
And Kelly is from Winter Park, Florida. You're neck of the woods, man.
That's actually where I was born, in Winter Park, Florida, at Winter Park Hospital. So Kelly, welcome to
There
the
you
show.
go. And Kelly and identifies as a she, her. So she's the lady of Winter Park.
Oh, the lady of Winter Park.
Kelly,
We hope to have you back.
Not a lot of people get a nickname on day one, but you just got it. You're welcome. All right. And we got a regular, Rosalind Riley. She's in the house as well, checking in. So, all right. Let's get to it, man. You ready to get
Game
to the
on.
property?
Let's do it.
Property time. All right. Let's magically whisk ourselves away here to, where's the thing I need to pull up? 2021 Stevens Street, Jacksonville, Florida, 32207. We are at a purchase price here of $275,000 for a 4-bedroom, 2.5 bathroom house of 1,549 square feet, a monthly rent of $1,713. It is completed new construction status, leasing term of 2 to 3 years, annual appreciation rate, which is what we love about Jacksonville here, of 4.6%. And of course, what we're actually buying here is this IRR of 13.1%. That's before I jump the gun. GC, what do you love about this property?
Thought you'd never ask. I'll tell you what I love about this property. We're gonna go right on where you almost did like a double take when we're talking about that.
I did. I 13%.
You know, we just need to keep in mind here of what a tough time it is right now to be an investor. I've been an investor for 17 years. I can't remember a more difficult time than right now. Normally, when I am showing people the advantages of rental property investing over stocks or bonds, normally, you know, either stocks or bonds are doing well. Because normally people invest in the stock market for the upside, and when they want to get more conservative, they go and rush to bonds because bonds usually protect them. That is not happening in the market today. Both the stock market and the bond market are in bear markets, which means they've lost over 20% of value. So investors right now really do not have a place to hide, right? Investors are considering just putting their money in cash. But the problem here is if you put your money in cash and inflation is 8.2%, that is like you going to the table to make an investment and then just saying, listen, I'm going to accept negative 8.2% return on my money, right? So it's like, usually you either go to the stock market or you go to the bond market if stocks aren't working well. In a worst case scenario, maybe you stick it in cash and maybe inflation's only like 2% or 3%. At that point, you're losing 2 or 3%. Yeah. But now you can't even put it in cash and feel good about just losing 8% year over year. So investors are in a really, really tough spot. Now, if you fast forward this conversation to real estate, to rental properties, right? Rental properties are poised to perform in the short run and in the long run here. And so it is just, I just think we need to put a microscope on how, like, this 13% return, this IRR of 13%, like, what is this? In a world right now where there are very few investments that can beat inflation, there are even fewer that are risk mitigated. There are even fewer that have more than one profit center. And so when I look at this and I see 13% estimated return on investment, that's your money earning 13% year over year over year, right? In a foreign investment that you don't have to take an outsized amount of risk, right? We're investing in housing, which is a critical need that performs very well. We've seen it even perform well in the pandemic, right? There's just this wonderful combination of above average returns. You don't have to take outsized risk, and it can be passive and it can be enjoyable if you find the right partner. So that's the first thing that I love about this investment. Really, that's about this investment model.
Yeah.
I'm going to go one step deeper though. We're going to focus specifically on this home on Stevens Street. This one on Stevens is available, by the way. This one, if I showed you even more of the details on it and we looked at the insurance cost on this one, the insurance premium for this home is under $500 a year. Under $500 a year is what you pay for homeowners insurance on this home. And there's been a lot of talk about how Florida has been beat up by insurance costs. And that's a real thing, but that doesn't really affect new construction properties. New construction properties are not dealing with some of the challenges that the existing inventory insurance market is dealing with. And so new construction is a way, and that's another strategy for us to maintain positive cash flows, maintain all 5 profit centers working for you. It's because you can buy a property like this and have insurance rates that are really affordable. And again, under $500 for this property.
It's a lot to like, man. I see here in the comments, right? We got educated community members. Kemmeline's talking about this is a typical narrow house on a narrow lot, right? Like one of these models that JWB builds over and over again that maximizes space on a narrow lot for rentability. And Denny's asking, why aren't they talking about the baby blue paint job? What's going on there, GC?
Yeah, I don't know. I don't really see colors, so I didn't even notice that. But I'll take your word for it.
That's right. You are blue-green. You are blue-green colorblind, right?
I'm challenged.
So, yeah.
Challenged.
So this actually has a baby blue paint job, but I think that's a good opportunity to talk about the idea of like, does it matter what it's painted like? Does there's a lot of talk about curb appeal when it comes to real estate. What do you think about that? You see, I mean, this is a pretty house, right? Like it looks good, but tell me what your thoughts are on curb appeal when it comes to rental properties.
Doesn't matter when it comes to you making an investment in a rental property. It doesn't matter the curb appeal, right? All of those, like, listen, you can't have a house that looks terrible from the outside, but a baseline standard of curb appeal is all you really need, right? And in fact, if you're thinking about it from your investor lens, if you put a whole bunch of time and energy and money into curb appeal, landscaping, things like that for your resident to move in, I can guarantee you your resident is not going to keep that up. So it would be a wasted expense. And even if you try to make your resident keep it up, you're just asking them to spend money, time, energy on doing something that is taking away time, money, energy they could spend elsewhere. It's just not a valuable proposition for anybody here, right? We want to keep our costs affordable for our residents and easy to maintain and things of that nature. So curb appeal is not important, but I will tell you that we do change up the colors. So knowing that this is a shade of baby blue, which I can kind of see here, you don't see that on every home. One of the things that we do is we build out a lot of homes in a small relative area. This home on Stevens Street has a lot of other homes or in that general vicinity, right? In a quarter-mile radius, there are a lot of homes that JWB has built. What we have to be cognizant of is not building the same home with the same facade and the same color scheme every single time, right? We don't want this to be Pleasantville, right? So we strategically will change that up, but these are not extravagant color designs. And of course it's low maintenance when it comes to curb appeal on all of them, but we do change up the exterior of it.
Interesting. I mean, that brings up the whole, like, JWB as a placemaker, right? Which we talk about turnkey companies and we talk about vertically integrated companies. Right. And the big difference being that a turnkey company, will give you a turnkey transaction, but they don't necessarily control the whole experience. And JWB is unique in the sense that not only does it control the whole experience because it has everything in-house, but you also play on a neighborhood level and on a city level. So you think about things like placemaking and the idea that if one street has 10 houses that all look exactly the same, it's going to kind of devalue the feeling of the street and whatnot. And you actually think about that we haven't talked about in a long time.
Yeah, I don't think we've ever.
Yeah, how you improve neighborhoods we talk about, but not in that regard.
Yeah. I just love it. And it came from a great comment. I think it was Denny who just asked about the baby blue shade of color there. So there you go. I love all the feedback. You guys help us make it better.
I love it. I love it. All right. So GC, you talked about a couple of things that you love about it. The first thing you talked about was this IRR. 13.1%. What goes into this IRR? Like, explain to me this thing. Why is it 13.1%? What are we looking at?
Yeah. So sometimes we get kind of like caught up in like IRR terminology and whatnot. I mean, and sometimes people say like, okay, is that 13% that I'm going to earn over the lifetime of my investment? Is that over a 10-year stretch? And what I really want to point out to people is, no, this is your money literally earning 13% this year and next year and the next year. On average, it's your money earning 13.1%, based on the property valuation that we put in front of you. And that property valuation is built off of, long-term thinking, either in terms of analyzing the Jacksonville market when it comes to home price appreciation or rent price appreciation. We don't just take the last 2 years, which I see a lot of providers out there doing, just using appreciation rates like 5%, 8%. I just sent you an email the other day, didn't I?
You sent me a lot of emails.
Well, I sent you a lot of email, but the one that I sent you, I said, look at this provider. They're counting on 8% home price appreciation. It was for a market like Kansas City or something.
Yeah, that email.
That email. I hope you flagged that email.
I flagged that provider.
Yeah. It's very common. I'll tell you, I see the data. I know what home price appreciation rates are for Kansas City. They haven't averaged 8% home price appreciation ever for a 10-year hold or a 20-year hold. So for other providers to use 8% or 6% or 5% or 20% home price appreciation, it's just not real if you're buying and holding this asset class. So anyways, when we put an evaluation together, the way that we get to IRR is we think long-term and we use long-term data when it comes to the market. So in Jacksonville's case, even though we've seen 20%, 25% home price appreciation over the last 2 years consecutively, you'll see that estimated annual home price appreciation rate of 4.6%. Well, that comes from data because I look over the last 40 years to see what our average annualized home price appreciation rate is. And then the other long-term thinking that we use is we analyze our own client portfolios to see things like maintenance cost and vacancy cost and to see how those costs will affect. And so we add all of the good things like home price appreciation and tax savings and principal pay down. And we take into account the bad things like maintenance cost and vacancy cost and your property management fees, which you will have, right? We take all of those things together. We run that on a true 10-year IRR schedule, which is important because the timing that you use these factors in really affect these estimated returns on investment. And at the end of the day, the reason that we do that is because I care about showing up 10 years, 20 years down the road and being able to show you that, listen, you signed up for 13%. We are better than that. We're at 16, we're at 18, we're at 20. And this has been it's one of our core values is to underpromise and overdeliver. And I'm really happy to report to everybody. I've been kind of sharing this more and more over the last month or so, but I've analyzed every single client portfolio that we have. 100% of JWB clients are beating their return expectations. 100%.
Wow.
So that's why we think so long and hard about these projections when we go in so that I can continue to say that.
Yeah, I know you like saying that. All right. So to kind of sum it all up, right, that IR is a 10-year snapshot of what the return looks like in 10 years. And it includes every cost that goes in from tenant placement fee to maintenance to closing costs, all these different things that happen, the type of stuff that happens 100%. In 10 years, and then compared to the 5 profit centers, which is the cash flow that you get, the tax write-ups that you get, the debt pay down that you get, and the home price appreciation, averaged at 4.6%, which is a historical average in Jacksonville.
Right.
Yes, it's been like 20 and 18 and 12% lately,
right.
But you use a very conservative historical average figure that in an email, we noticed that other people are not doing, right?
I haven't seen any other providers actually use their actual historical home price appreciation rate for their market. I've yet to see it.
Okay. I like it. All right. So we got a great question here from Melissa Matthews. Melissa, good to have you here on the show. She asks, I noticed the rent amount is a lot lower than 1% of the purchase price. Is this no longer a good rule of thumb? I know it's difficult to get in the current market, but it seems rent is way below that mark.
Melissa, great question. Yeah, I'll answer your question directly. Is it no longer a good rule of thumb? Correct. It is no longer a good rule of thumb. The 1% rule was common when I started to invest. And, that was 2006 and 2007. And it became more common as home prices dropped after the Great Recession. Rents stayed high. And so 1% is saying that if you, bought a house for, $200,000, that you would get $2,000 a month in rent. And, that may have been possible at some point back in the day, but that is just not possible today if you want to be a passive investor. If you want to work with a vertically integrated company to buy a turnkey property, just not going to happen in a growth market like Jacksonville, and really hard to find even in other markets now. Like you used to be able to find it in places like Cleveland or other places, maybe 2 years ago, 3 years ago, even working with a turnkey provider, really can't find it now because home prices have gone up across the board. So I feel really confident telling you that it's no longer a good rule of thumb if you want to be passive. If you want to be active and you want to take the time and energy and money and try to do this from an active perspective, what that means is you're buying properties under market value. That's why you're being active with it. Then you may get a good enough deal that you could put this together and maybe get into the 1% rule, but not for the passive side, which is, the majority of our not your average investors want to be passive with this.
Greg, when I hear you saying that, I'm essentially hearing you saying cash flows have gone down, right? And while that was already happening in Jacksonville before, Jacksonville being a growth market because it has the highest home price appreciation of all the cash flow markets versus other markets that just have cash flow and the home price appreciation isn't that good.
Right.
I'm now hearing you say that even in the other markets, cash flow has gone down significantly and that 1% doesn't exist there. I'm just clarifying.
Yeah, absolutely.
So then my next question is, if all this cash flow is going down, are rental income properties still a good investment? Like if they're going out all over the place, right?
Well,
how much cash flow is too little cash flow?
If all you are doing is looking at cash flow, the answer would be no. But if all you're doing is looking at cash flow, you're missing the big picture about what makes rental property investing so incredible.
All right, tell us the big picture, bro.
The big picture is called 5 profit centers. Cash flow is one of those profit centers. And investors, man, it's just like, I just wish people would just expand their horizons a little bit, just because cash flow happens to be the easiest profit center to calculate. That's what most investors gravitate to, especially newer investors, right?
Yep.
It's all about cash flow. It's all about cash flow. It's all about cash flow. But as an experienced investor, and I manage over $800 million of real estate assets, and I own 300 rental properties of my own. And, we've sold 2,800 rental properties to clients, and we do it all here in Jacksonville for 17 years. So I can just speak from this experience with you. I get to see what these portfolios look like 5 years, 10 years, 15 years after people started to invest, my own rental property portfolio. And every time I do that, I break it down by what percentage of the total portfolio, what percentage of the profits came from cash flow? What percentage of the profits came from tax savings? What percentage of the profits came from principal pay down? These are 3 of the profit centers. What percentage of the profits came from home price appreciation? Right, that's 4. The 5th profit center is inflation hedging. So I get to see across an entire amazing data set of people holding on to rental properties for a long time. And this amazing trend starts to emerge. Every single time, between 60 to 80% of somebody's total portfolio returns come from one profit center. And guess what? It's not cash flow. Cash flow is near the bottom every single time. That one profit center is home price appreciation. 60 to 80% of your overall returns when you hold on to rental properties will come from home price appreciation. And it doesn't matter whatever market you're in, doesn't matter when you buy, as long as you buy and hold for a full market cycle, it's going to be this way. So I'm really passionate about helping people look beyond just cash flow, because flat out, if all you're looking at is cash flow right now, you shouldn't be investing in rental properties. It makes no sense, right? You're about break even day one. Over time, you will be earning a lot more cash flow. But day one, if you're just looking at cash flows day one today, you're missing the boat. You really are.
Yeah, I like it, man. So since Melissa's been here a couple of times, but maybe she hasn't been here we do a lot of these like portfolio breakdowns, right? And we visualize it. And it's always like a Pac-Man figure with a couple of with 3 teeth, right? And it's like one tooth will be cash flow, one tooth will be home tax savings, one tooth will be debt pay down. And then the Pac-Man itself is home price appreciation, where the bulk of
like the gator,
like a gator chomp. Yeah, like a gator. And that's how we see it. The other thing that I'm hearing from what you're saying, which I think we've been keying in more on, like, what are the answers that they're actually really seeking, is the idea that this is an asset that you invest in for a long term, right? Like, if you want a consistent experience, if you want these numbers to be real to you, then you're thinking about this as a long-term investor. This is a thing that you are putting in somewhere for at least 10 years so that the market cycle can like play out and you can even out, you can make that Pac-Man happen. And if you're somebody that's more like, well, this is like 2-year money and I want this cash flow to pay for my stuff because I wanted to pay for my cell phone bill today, or I wanted to pay for whatever, then, this may not be the asset class for you. But if we're building wealth long-term here, the idea is cash flow is not very big today, because that's not what you're counting on it for. Like, you're not counting on the cash flow from your IRA or your 401k or even your stock portfolio. Most people in their stock portfolio are like, no, man, I'm just letting that thing ride. Yeah. Right. Even if it's in your IRA or not. Right. This is the cash flow that you're counting on 10 years from now, 20 years from now, 30 years from now, when the debt is paid down, the thing is appreciated, you can refinance, rents have gone up, all that stuff. Right. So that's, at that point, it's going to be way more than 1% because you're doing real well, because this thing works in time, right?
Yeah. Let's put a couple qualifiers there, because you and I just walked down the path assuming that people are buying with conventional financing.
That's true.
Right. And and all of that is 100% accurate, right? If you're buying with conventional financing, cash flows are really break even is all you need, right? You just need it to pay for itself, because no matter what market you're investing in, you might earn $100 a month in cash flow somewhere. It's not going to change your life.
Yep.
It's not going to change your life. And if you analyzed your return on investment of that $100 a month in cash flow and compared that to other investment options, you could probably do better elsewhere. Right. And you're certainly not getting in the stock market. So I think that's a really valid point. Let's flip the script a little bit. All right. Because this was really cool. My teammate, Tara, one of the leaders on our team, and she is listening to the show. She'll probably listen to this one here. If it's not live, she'll listen to it in the future here. And
Tara, the keeper of the data flywheel.
Mother
of flywheels.
Mother of flywheels. She texted me on the way to work today. She goes, "Hey, I was listening to this episode where you were talking about the advantages of buying in cash." And she said, I had this friend whose family was talking about pulling their money out of the stock market and just putting it in cash. She goes, why on earth would people just put their money in cash? If they're let's say that they're scared about the market going down in value, the real estate market in prices, and they're worried about that going down in value. She goes, if they're putting it in cash, they're going to lose 8% on their money. Why wouldn't they just buy a property with cash? Right? Because at that point, your cash flows are actually high, right? You might earn 5% or 6% on your money because you don't have the mortgage payment to make on it. And you still have the upside over the long haul. And so it serves a purpose, even if you want to be completely risk mitigated here. And you tend to believe the headlines and you think that home values may go down. Hopefully you can agree they're not going down as far as what's going on in the stock market right now. But you have the ability to get an income stream if you buy in cash, and it might be 5% or maybe 6% or something along those lines. So I just thought that was a really cool point that she pointed out, something that we should share with our audience. Overall, the best way to earn the highest risk-adjusted return and benefit from all 5 profit centers is to use leverage to your advantage and to hold for a full market cycle. But we can easily talk about how this makes sense, even if you feel like home values are going down. You compare that to the losses you would be taking in the stock market, right? It's going to be less, right? And you say, listen, I just want income during this time. Buy it in cash. Buy it in cash. And, you still have options down the road. If you want to leverage down the road, you can always refinance down the road. So I thought that was a pretty cool thing to bring up. And hopefully that helps our audience a little bit.
That is pretty cool, man. That's really cool when you're like reading these reports of just like nothing to do in the market, just hold it in cash. This idea, like when you brought this up a little while earlier, the idea that, man, this thing is $275,000, right? If I'm going to have $275,000 that I'm just like pulling out of the market because I'm scared that I'm going to lose this value on it, instead to put it into a house, right? And have that thing start spitting out cash that you can reinvest or do whatever you need to do with it. And the fact that in 2 years after this crazy market thing that's about to happen, right? Because we've all agreed that we're going into a recession. Jamie Dimon is calling for like Armageddon, right? Like
crazy stock market thing.
Crazy stock market thing that we're going into, right? Like in 2 years, you can just refinance your house and put it in, take that cash out and put it into another asset or another house or whatever it is.
Right.
Man, that is so profound. This idea of like sitting on cash versus putting it into a property that is well managed. You don't have to worry about, and like, you're just like in on that, and it's just holding value, keeping up with inflation, spitting out cash flow, and giving you these tax benefits and all these different things, man.
100%.
That's interesting. That's really cool. All right, man, let's get into some of these questions. And Nadeem has a question. Looks like a flat roof. What kind of roofing does it have? Shingles, tar, gravel, or foam? Do you know about the roofing kind of specifications out here, GC?
No, I should know that, but I don't. I don't know all the construction details, to be quite honest, but I know who does. Our team.
Yeah.
So Nadeem, just reach out to your portfolio manager. We can get you that information. I will tell you, there's no such thing as a flat roof. Like, even though it looks flat, it's not actually flat. That
low slope.
Yeah, low slope. So I do know that. But as far as materials, I should probably know the answer to that. Maybe I'll figure it out for the future. So I should probably know that one. But just reach out to the portfolio manager.
Got it. And Stevie B is also asking, where's the second page showing more details? So Stevie B and anybody watching the show in the future, if you go to jwbinventory.com, you can download the performa of the house. It's the interactive spreadsheet that has everything here, and you can use it to break down your own deals. So now moving on to the Q&A. Ken Moline asked the question, patriarch of the first family of the Not Your Average Best Show, asked the question, salute you. In your 10-year evaluation of homes, do you use the JWB turnover rate of 4+ years or some other figure?
Great question, Ken. Yes, we use the turnover rate of every 4 years. The average JWB turnover rate is actually 4.5 years. And so if you go to jwbinventory.com, you'll have the ability to download this evaluation. And then what you would see is every 4 years, you'll see a tenant placement fee. And that would happen when a resident moves out and a new resident moves in. And so, so that's how we do that.
And for newer members of the community, the reason he's saying 4 years is because the average resident stay at JWB is how much?
4.5 years.
4.5 years, right? So you all do that by signing long-term leases and going really, really hard at re-signings. What is the term?
Lease renewals.
Lease renewals. I knew it had a risk somewhere. So lease renewals, which at the end of the day, we've learned on this show through time that length of stay of your resident is what drives that over deliver, kind of like part of the investment of the portfolio is keeping somebody in there, not having turn cost, keeping that thing running and funded, 100%. Right? Cool. Lee Bishop, MVP of the community, asks, I love that this house is below the 65% of the FHA cap in Duval County, Florida. This makes the resale easier. I also noticed that the price per square foot of the home is $177.53. And that sounds like it is high, but really is in line with prices now in Duval County. My question is as follows. Does JWB follow these guidelines when establishing prices on houses for investors?
Lee, I love how much you know about rental property investing and investing in general. And I just appreciate you being a part of this community so much. These are cool terms that I don't think we've even said on the show before.
I'm just,
right.
Yeah. That's why I went real slow. I don't know if you know.
But the answer is, we do not focus on price per square foot or the FHA cap when we are putting an investment together for you. Now, that's not to say that it doesn't usually materialize this way. It's because we focus on the same area. We're vertically integrated. We only focus on Jacksonville. And in Jacksonville, we only invest in 4 neighborhoods because these are the perfect neighborhoods for you to benefit from all 5 profit centers. And when you do that, the pricing that you tend to buy for and the construction that you tend to build for and the sales prices that you tend to sell for and the rents that you get all are very similar. And so it happens, we net out to the same effect where you have a similar price per square foot. And the FHA cap, which I've never even really paid attention to be quite honest, it's not surprising that most of our homes are that way. Just put it in perspective, the median home sales price in Jacksonville as of September, hot off the press, which we just shared on Tuesday, was $357,900. $357,900.
That's way up from before.
Way up year over year,
Yeah.
which is the way that we actually analyze home price appreciation. So just keep that in your back pocket. It's 20% up from where it was a year ago or whatever, when people tell you that real estate is going to crash. The other thing to keep in mind here is that home prices from August actually went up in September. Now, I'm not a big proponent of looking month over month over month, except when the entire world tells you that home prices are crashing and falling and that the market's going to bottom out. Well, I think it's interesting for everybody to know that home prices in Jacksonville in August were actually lower than they are in September. So home prices in Jacksonville are actually increasing. Overall, I do expect home prices to go down towards the end of the year here in Jacksonville because that happens every year. It's called seasonality, but our home prices are actually falling less than a normal seasonality effect. And so when you look at this home at 275, right, that's in that workforce housing type of neighborhood that we want to be in. Median home sales price is about 360 here in the overall Jacksonville market, and that's where you win.
Jacksonville market, man. Every time you bring up data out here, it just looks so strong all the time, right?
Yeah.
And I can say as a resident, that's one of these data points. I moved here from elsewhere. Like, I totally understand why.
Yeah.
It's got all the things. It's got all the things. All right. So Gerard Wendling has a question. Hello, all. Why don't all Jacksonville neighborhoods have access to city water, city sewer / water utilities? Do you know about that, JC?
I think I think there's a whole lot of politics and budgeting and, there's just priorities that the city has made to focus on certain things and less in others. There are parts of Jacksonville that have not been served as well from a city water and sewer perspective. That's just a reality. And but I can tell you that our mayor, Lenny Curry, who we're really hoping to get on the show here pretty soon.
Mm-hmm.
Really hoping to get on the show.
I see a little twinkle in your eye when you say that.
Pretty soon. He put a plan together to create a gas tax, and it was approved last year. And a big portion of the funds raised by the gas tax are to go to serving communities who have been underserved from a utilities perspective and to bring city water and sewer to some of those neighborhoods. So hopefully that will become less and less of an issue, going forward. And but yeah, that's just a reality. A lot of neighborhoods in Jacksonville still do not have access to city water and sewer, and happens to be a lot of the neighborhoods that work really well for this investment.
Awesome, man. Awesome. This has been a fun show, man. I think we're going to wrap up a little early here, but Ken's got a great comment here in the chat to what you were talking about where you put cash.
Right.
And if you're in that season of your life where, you're living off of this cash flow, I think it's really, really relevant. We talk about his story all the time, but Ken, who is in his 80s,
right,
and started in his 70s. Older folks who are in need of better cash flow should plan on 2 to 3 totally owned homes in their portfolio. You still benefit hugely from the other for-profit centers. Younger folks can reach this plateau through accelerated mortgage paydown plans.
It's so well said. I'm so glad that we have Ken's perspective here.
Yeah.
Right. He's living, breathing like this investing strategy, and it's making an impact and a difference in his life. And he's making a difference and an impact in all of our lives by continuing to be such a valuable member here. So we just appreciate your story, Ken.
Totally agree. GC, this is a great show, man. I love the Thursday POT Dubs. I encourage all of you to keep the conversation going. Be like Michael Santorios, right? Take this thing to the Facebook group. Look up the Not Your Average Investor Show Facebook group on Facebook. Join us in there. There's almost 4,000 people, right? Like, we keep the conversation going. Let's keep connected during these times. And I just want to say to those of you, we had like 40 people on still right now, and it's like really blows my mind. Middle of a Thursday, take an hour every day to come hang out with us. We kept it short today, but take almost an hour every day to hang out with us. It's just like, I'm so grateful for all of the great context in the chat, like Ken's story, like Melissa's question, all these different things that add value to the show. You make it really, really easy on us and you make it a lot of fun. So I just really, really appreciate you being here. GC, I'll kind of give you last words.
Yeah. And for anybody who wants to take a more direct approach to getting to the Facebook group rather than the willy-nilly, just search it on Facebook, there is a URL for that one. Did you forget that one?
I didn't forget it. You want to say it?
Yeah. JWBFacebookgroup.com. You can go there and be a part of it. And you're right, man. I sit back sometimes and I just think about how much fun this is, right? They always talk about how, you'll never work a day in your life if you find what you're passionate about and surround yourself with great people. And I just feel like that's what we get to do here. And we get to do it twice a week. And, it's a really special thing because when we started on this crazy journey, I never thought it could be what it is. And so
it's true.
You all are the reason for that. It is. We appreciate you. Can't wait to do it again next Tuesday. And man, have a great rest of the week.
All right, man. And if you're gonna want to make smart moves during these tough times, you just can't think like an average investor. See you on Tuesday.